Hello everyone. So an investor who I like to keep in mind when making decisions has just come out and said something about a company I like to keep an eye out for as well. So today I'm going to examine what Michael Burry has just pointed out with regards to Tesla's susceptibility to an inverse gamma squeeze. What exactly he is talking about and what this could mean for Tesla's share price going forward. So stay tuned. Hi everybody, welcome back to The Contrarian. For those of you who are new here, my name is Logan, and I really like to talk about overall success in investing, as well as going against the crowd, as my title implies. So if you like these kinds of topics, just consider subscribing. And I'm also not a financial advisor, so just don't take any of this as financial advice. And a brief disclaimer as well, I actually was long Tesla stock for a couple of years, back about 2 to 3 years now. I'm a big fan of what Elon Musk has done, but I'm just not a fan of current valuations put on Tesla's stock. So to get started, let's look at Burry's tweet last week regarding Tesla's ability to undergo essentially a reverse of what has happened during the last year to Tesla's stock. And in case you've been living under a rock for the last year, you've probably seen the meteoric rise Tesla's share price has had from roughly $70 in March of 2020 to $900 at one point early in 2021. So this has been one heck of an increase, and it definitely has not escaped the attention of Michael Burry, who has been short Tesla since December of 2020. So he thankfully for himself, he held off for a long time on getting into that short position, but he did jump in a little too early, at least from where we are right now, and the price has risen some 30 or 40% from where he bought in back in December. So Burry's tweet, this is not me and makes no sense to me. Tesla is, however, susceptible to a reverse gamma squeeze using puts and performed by institutions. Tesla's short interest is around 2 days volume, too small for a normal short squeeze, but the Tesla cult has made out of the money puts cheap. Boomerang. So Burry is essentially saying that while this was not him buying all of these put options, he is referencing he does think that Tesla is susceptible to an inverse gamma squeeze. Now, had I mentioned the term of a gamma squeeze even just a few months ago, I don't think many people would know what that is, but since the GameStop short squeeze and gamma squeeze that just occurred about a month ago, it has been much more widely talked about since then. And essentially what Burry is saying is that the factors that drove Tesla to such an extreme valuation and what drove GameStop up, higher than anyone thought possible, could now work in the reverse against Tesla's share price. So this would be sort of a gamma crush, if you will. I don't know if that's an official term, but I'm gonna call it that. Now I'll briefly explain what a gamma squeeze or crush in this case is. A gamma squeeze, such as what just happened last month in GameStop, is the rapid purchasing of call options by speculators and investors. And in purchasing many more calls than puts, they force the sellers of these options, so whoever they are, banks or institutions, they force them to hedge these option contracts by buying shares in the stock in order to hedge against their potential loss. So even though these speculators aren't buying the shares themselves, they are forcing the sellers of these option contracts to buy shares in order to delta hedge their position. And in buying many multiples more calls than puts, these people were able to successfully drive up the price in GameStop, and this in turn led to other people buying more call options as well as some short sellers covering their positions. So this is what happened in GameStop and in Tesla. GameStop was a much more rapid acceleration of that. Tesla was more drawn out, as can be seen. And Michael Burry also refers to delta gamma hedging and just it's a very basic formula actually, how much you can calculate how susceptible a particular company might be to delta gamma hedging. The process Mr. Money Manager uses to stay neutral when selling you out of the money options by buying or selling shares. NOPE is a rough and dirty way to approximate the impact of delta gamma hedging as a function of share volume. So as you'll see, obviously the higher the volume and the higher the amount of calls or puts is greater than the other, the more you can either influence a share price to go up or down. And obviously, this is inversely proportional to the daily trading volume. So in the case of GameStop, that is why it was such a dramatic increase, is just the volumes of the call options being purchased were so much greater than the volumes of put options being purchased, as well as the entire thing was much greater than the average daily trading volume. So that's why GameStop's gamma squeeze was so rapid and so dramatic. And this type of gamma squeeze is also likely what was part of Tesla's rise, though there have been other factors as well, don't get me wrong. There's also been the exiting of short sellers. Just remember back about a year or two ago, Tesla was one of the most shorted stocks on Wall Street, and now the short interest is down to 5 or 7% now, which is very low. That's kind of your average for a company like that. I bet Amazon and Apple probably have very similar short interests. But they've also had hype from the Cybertruck and new battery technology, and most recently the inclusion in the S&P 500. So these have all been other factors as well that have driven Tesla up around 12 times in the last 11 months or so. And you might ask, how could this happen in reverse? And I'll lay out the factors as they stand right now. And apart from being extremely overvalued by any conventional method of valuation, even if you say that Tesla is a car, battery, energy technology, solar company combined, which I disagree with. I don't think it's all of those at the same time. But let's just assume that that's true, that it's all of these combined. An autonomous vehicle technology company, a battery manufacturing company, even though they license the technology that they put in their batteries, they license it from other companies like Panasonic. But let's just assume that it's all of these companies combined. You still don't get anywhere close to the $800 billion market cap that they're at right now. Just with the earnings they have, the revenue they have, they're nowhere near that, even if you say that they're all of these companies combined. So even in the very best case, they're not. They're very overvalued, even just looking at the best bullish case scenario. And the growth in the fundamentals just aren't there. I still like what they've done as a company, and the cars are really cool and all. And they have a lot of well-known people behind them, such as Ron Barron and Larry Ellison, and so they have a lot going for them. But actually a lot of the insiders have just, they've trimmed a lot of their shares recently. But bottom line is just this valuation cannot last, in my opinion. I say this with confidence that Tesla is probably the single biggest overvalued company right now, and potentially in all of history up to this point. So hopefully we're on the same page in terms of it being overvalued at this price. But if you don't agree with me, I don't think there's anything more I could say that would convince you, so I'll just move on from here. Here's another one of Burrys tweets kind of getting at the valuation issue. Well, my last big short just got bigger and bigger too. Tesla, a $60 billion increase in market cap today alone. 1 General Motors, 2 Hershey's, 3 Etsy's, 4 Domino's, 10 Vornados, enjoy it while it lasts. So yeah, he does not think it can last at all. But now getting on to the reverse gamma squeeze. To have a reverse gamma squeeze, simply put, a lot of investors or several institutional investors would need to start purchasing large quantities of out-of-the-money put options. And as Burry pointed out a few tweets ago, I showed these put options have become very cheap just because of the extreme rise that the share price has had. And the rapid purchasing of these put options would result in the sellers of these option premiums selling shares to delta hedge their positions. And you could suddenly have a very rapid decrease in the share price in a short amount of time. But this is just from the gamma side of things. And this could kind of just be the start, if you will. Let's say if Tesla's share price were to fall, say, 30, 40, 50% from here, so down to, $500 again or $600 again, all of a sudden a lot more selling would begin to take place in these index funds that hold Tesla, because remember, these index funds are market cap weighted. So all of a sudden, if they have a 30% decrease in the market cap of a large stock that they're holding, they're going to trim that to adjust for this large decrease in market cap. So that's also another factor that would come into play. And then, of course, you would have a lot of these new, smaller investors who have gotten into Tesla, say, in the last 1 or 2 years. They would probably be getting scared and dropping their shares as well. So in my mind, this actually seems like if this snowball gets going, whatever starts it, if it starts by this reverse gamma squeeze, or if it starts by just a simple market correction, for whatever reason, if Tesla starts going down, this could really accelerate it. In other words, it could go down just as rapidly as it's gone up. In other words, kind of like what we've seen with GameStop, of going down something like 80 to 90% from the highs that it reached just a month ago. Now it's down to, it was at around 480 at its top. Now it's down to around 50. I think that a similar thing happening to Tesla, of it going back down to the lows it had about a year ago, isn't out of the question. But bottom line, I just don't think that such a crash like this would be out of the question. Now again, none of this is to be taken as advice, but this is just hopefully some helpful information for you to consider. Again, yeah, I am not short or long Tesla right now, but I was actually long Tesla 2 to 3 years ago. It did work out very, very well for me, but it's just extremely overvalued right now in my opinion, and I wouldn't touch it as a long-term investor. And yeah, I really take my hat off for Michael Burry. He's definitely putting his reputation out there on the line going short like this, but only time will tell if he's correct in this or not. And yeah, so if you like these kinds of topics, just consider subscribing, and I hope to see you again.